Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is if you had just one chart to give you a good read on the overall market environment, besides just a regular chart of the S&P 500, what would it be and why? So here's my one chart for today. It's a 10-year chart of the S&P, but at the bottom we have two key breadth measures. The first is the percent of stocks in the S&P 500 above their 200-day moving averages. At the bottom, it's the percent of S&P names above their 50-day moving averages. Here's why this is an important chart. If you look back over the last 10 years, overall, we've been in a secular bull market, for the most part, a cyclical bull market as well, with some notable exceptions, arguably 2015 to 16, 2018, arguably cyclical bear markets within that period, but overall, the trend has certainly gone up and to the right. If you look at the second panel, which is the percent of stocks above their 200-day moving average, you'll notice that in this overall bull market phase, when the market sells off, one of two things tends to happen. Number one, you tend to find support at the 50% level, meaning we drop to about 50% of S&P stocks above their 200-day, and that's about it. Goes maybe a little bit below, but then comes right back up. So the pullbacks in 2012, the pullback in 2014, 2016, 2018, also 2019, you can see all fit that characteristic where, the market overall is trending higher. These end up being relatively buyable pullbacks when it gets down to 50%, but doesn't really go much below that. If you look at the other times, though, the time when it went right through that 200 or that 50% level, it keeps going. That's when it tells you it's more of a deeper time and or price correction. So it happened here in 2011. We broke right through this 50% level. The S&P rallied after that first low, but ended up finding a lower low before the trend reversed and we went back up. You also see that in 2015, we went down below. We had a lower low before we resolved higher. Maybe the one difference was here in 2018, but not really, right? Because we broke down here in October. This was that first initial pullback. But then you can see we ended up finding a lower low toward the end of 18 into the market low, Christmas Eve of 2018, as the breadth measure bottomed out around 10%, which coincidentally was right about where it bottomed out here in 2011. So that brings us to where we're at today. One of the issues I have for people thinking this is just a shallow pullback, a quick pullback, it's going to be more of a V bottom. This is a great opportunity to buy on weakness. I'm looking at this and I'm seeing when we blow right through that 50% level, which we've done in the last week, it tends to signal a deeper correction. Number one, more time. Number two, deeper price. So in each one of those cases over the last 10 years, the market's seen a lower low before it's eventually recovered. So at this point, that's why I'm feeling like the market still has more time and price to go on the downside before we can say that this sort of downtrend, pullback, corrective period is anywhere near over. If this sort of thinking about investor decision-making, behavioral finance, and routines is of interest to you, I hope you'll hit subscribe. Check out some of the other videos on my Market Misbehavior channel. Have a great day.